We're here with Paul Colonna, CIO of GE Asset Management, and we're talking to him about restarting the private securitization market and unwinding government programs. What do you see as being the most important step to restarting private securitization?
Well, a lot of the steps that were taken in 2009, I think, were very successful for restarting the auto and credit card segments of the market, the CAL program in particular. The two main areas that we need to focus on going forward are the residential mortgage-backed securities market and the commercial mortgage-backed securities market. And then I think it's really a regulatory issue around those marketplaces to make sure that we don't introduce any new regulations that will inhibit investor demand. I think we saw from some of the surveys today from the general investor base that one of the highest reasons that securitization isn't starting is because there's a lack of investor demand. I think most investors, ourselves included, want to make sure that we don't have the regulatory environment, the unknown of the regulatory environment going forward that will limit the demand.
Do you see any sort of program, the TALF program has worked very well for autos and credit cards, and is starting to work for CMBS. Do you see anything like that happening for RMBS?
I don't. I think the issue with that market is that it's not a state of maturity. It's an amortizing asset base. It's more complex. All the structures are a little bit different, so I don't see that there will be a TALF-like program out there. They're going to provide some of the underpinnings. And again, if we can make sure that we don't do anything crazy with loan modifications, we make sure that we protect the rights of investors, and so that investors understand what their cash flows will be in residential mortgage securities. I think that would be the underpinnings for that market. But I don't see a TALF-like program going on for that segment of the market.
How do you see the government programs unwinding? Do you think that will be a smooth transition into the market, or will it be like a floor fall?
I think it will depend on the program. I think the TALF transition, and I do not believe that they will continue TALF as much. I think that will be very smooth because I think those parts of the market have already healed. I think we're already on a good course for that in 2010. I think the exit from the balance sheet purchases of agency mortgages and agency debt, about $1 trillion of assets that the Federal Reserve holds, I think that will be more problematic. I think that they will end their purchases in March, but then they will begin a process for exiting in later 2010, and I think that will create an environment, not a horrific one, but an environment where mortgage rates will generally be going up, and valuations of those assets, which have been very elevated during this whole process because of their activities, the valuations of assets will go down. So not catastrophic, but there will be some implications to the exit of that program. It will not be completely smooth, but then again, I would argue as well that higher mortgage rates, I think a lot of people talk about that, oh my gosh, the Fed's not going to buy mortgages anymore, mortgage rates are going to go up significantly. I would offer that yes, mortgage rates are going to go up, probably around 50 to 100 basis points, but I would also argue that that's not the issue. The issue is really credit extension, that the marginal borrower right now is not being shut out of the market because of the mortgage rate, they're being shut out because of credit extension. And I think that's probably the bigger issue going out past 2010 and 2011, not are we going to get 100 basis point move in mortgage rates. So let mortgage rates go up, let the banks continue to recapitalize over 2010, resume lending, and I think that's going to be the recipe for a smooth private mortgage market.
And you guys manage about $110 billion?
$110 billion total assets, about $60 billion in fixed income.
And what are you looking at for 2010?
Yeah, 2010 we believe I think you have to start with the interest rate picture, and I think there's been a lot of talk about if all the supply in all of the fixed income markets is going to be in the treasury market, right? We're financing a large deficit. There's going to be a lot of supply of U.S. treasuries this year. While we see that, we also believe that because the economy will not be on a pace to a very quick recovery, that there'll still be pressures downward in terms of interest rates. So we actually believe interest rates will be fairly range bound this year, which is not a commonly held view. So we think interest rates in the back end of the curve, the 10-year part of the curve, will be about 3 to 4% for 2010. So having said that, the opportunities for us then really end up being, I think, in some of the markets that have not quite fully retraced their valuations from 2006 and 2007. So we're looking at high yield bonds, which we think can deliver probably 8 to 9% returns in 2010. And then we're looking at some segments of the securitization markets, which we believe offer outsized return potential. Formally rated AAA CMBS, so the AM and HA tranches, which have large support levels and can weather a significant decline in fundamental valuations in commercial real estate and still deliver about an 8 to 10% return. And then some, probably Alt-A in particular, but some segments of the residential mortgage market. But every deal is a little different, so it's hard to generalize there. There'll be some opportunities, but again, it'll be in that 8 to 10% return range. So for us, those are the segments that can provide high returns. We would be underweighting a lot of the segments that we just talked about, where the Fed is going to be either issuing a lot, treasuries, or exiting from purchase strategies such as agency debt and agency mortgages.
Well, thank you so much.
Okay, yeah, no, thank you, appreciate it.